Good evening, Theo Trade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 13th of June, 2019. We're back on sectors, mainly defensive sectors. Those are the ones down here. That's our staples: XLV Healthcare, XLU Utilities. There's something strange about these names, and we'll talk about them in tonight's video. And of course, what that means for the broader market. Starting with this, the way we divide our sector charts is to look at the top three bullish or risk-on sectors. This is where investors or funds or just general traders park their cash or put their cash to work when they think the economy is expanding and they think all is well, consumer confidence, unemployment rate, inflation, all the kind of economic data, and they think the market's going to keep rising. Well, they may try to generate alpha or outperform the market by investing in these stocks, or at least these sectors. Those are financials, XLF, technology, XLK, and consumer discretionary, or retail, XLY. The middle sectors, we don't look at those as much maybe as financials and technology, but they're industrials, materials, and this one stands alone. It's energy, XLE. The three we'll talk about in tonight's video are staples, healthcare, and utilities. I've seen a lot of comments and questions in the chat room and even gotten a few emails with respect to why are these sectors or defensive names strong, and even positions into these sectors. Let's start with XLP, which is our consumer staples. This is consumer discretionary or retail or an offensive, which means risk on sector. And all the way over here is staples XLP, which is more defensive. And think about defensive stocks as no matter how bad the economy is, you still have to eat, you still have to brush your teeth, you still have to drink. So those are things that would be personal care, cosmetics, household goods, cleaning supplies, and the like. Versus vacation stocks or travel stocks, leisure stocks, or anything in clothing or retail in general. So it's easy to make the comparisons between the retail or discretionary and staples. Healthcare is another one. No matter how bad or good the economy is, if you have the sniffles, you go to the doctor. If you have any kind of condition, we have to have healthcare. So that's what we do in terms of looking at sectors that outperform the market in bearish or defensive or even recessionary times. Healthcare. You're not necessarily going to not go to the doctor, at least I hope we don't, if we need to. And that won't depend so much on the economic condition. That's one of those would outperform the market in a recessionary or bearish time. We call those risk off or defensive stocks. And the same is true with utilities. The same logic we talk about with bonds, that bonds rise, prices rise when equity markets fall. In other words, money comes out of the equity market into the bond market, or if things are good, they'll rotate capital out of the bond market and put that into stocks, maybe even sectors or leading names. So think of utilities, which also tend to have high yields with dividends and annual performance, little bonuses if you invest in utility stocks. They tend to pay higher dividends than most other stocks and, of course, most other sectors. That's important to know. Again, think of utilities as the super defensive sector. It's almost like bonds. With that in mind, we now look at where the price is on this comparison grid. These are the daily charts. And we're going to ask if these prices currently are at the top right of the grid, middle part of the grid, or lower right of the grid. That's going to let us know about relative strength and any type of investment opportunities, or of course trades we might want to be putting on or managing. So the strongest sector isn't actually technology, isn't actually discretionary or retail. It's down here. The strongest sector in terms of where the price is now is staples, followed right next door by utilities. Honorable mentions would of course include retail or the consumer discretionary sector, and there's our technology, but not financials. So that's a warning sign, one of many, just like the market into resistance and bonds keeping their rally going. It's just one more piece of the puzzle that suggests caution is the name of the game versus outright rampant bullishness. If you would have been expecting a continued bullish rally, or if you're thinking the market's going to keep doing well, you would want to see the exact opposite. You would want to see relative weakness, meaning XLP, V, and U would be at the middle part of their grids, maybe even the bottom right. That's not the case. It is the opposite. So that's giving us a defensive posture and logic for those traders that are putting on in-out spreads or call spreads or any type of bullish play into the staples, into healthcare. Now, healthcare isn't quite as strong as the other two. It's actually into resistance at about 92 per share. We'd probably pass on that trade. Utilities is the other name that is strong, and that is making new 52-week highs right there with staples over here. If you're looking for bullish positions or trends to continue, these would be the sectors to do it. And if the market falls, if we do get a market going down, but let's say you can only trade long, you can't trade short, and that may be the case in retirement accounts or just invested in mutual funds or other ways that you can only trade or invest in stocks. That's the logic behind this chart. If traders or funds, or especially mutual funds, they think the market's going to tumble or at least have a period of weakness in the future, well, they'll rotate their capital into one of these three or a combination of these three sectors. That is what we're seeing. And we'll finish up by looking at these three sectors on the daily charts. So we'll start with XLP, which is consumer staples. What do we have here? Wow, that's a rally. And that rally took us above the 2018 highs. That's a new 52-week high for the Staples ETF. For trading positions, if you had to do something in a market that's overextended above the moving averages, we'd probably put a short or some type of put position on for what's called a rubber band or snapback effect. Just like this, that, and that. We typically want to buy pullbacks into rising markets or rising trends, but we don't want to get long, especially after 1, 2, 3, 4, 5, 6, 7, 8 days in a row to the upside. So we'll be looking to either get long in the future off of 58 per share, or if you're super aggressive the next couple of days into next week, maybe play some type of put position on a departure or short-term sell swing against 59 per share. A little bit different, but healthcare is part of the structure, and it's not at the prior highs. So keep a watch on this one. If you're looking to be bullish, probably healthcare is not the one you want to do that with. It is into a key resistance point at 92 per share, and probably, like the other stocks or sectors, trades down away from it short term. So we don't want to get long right now, but that picture would change if the market breaks above 92 per share or even 92.50. And we'll finish up with XLU, which is utilities. Think of these once again, in a sense, like TLT or IEF or just in general bond funds. So XLU just peaked at a new high into the 61 per share level, but pulled back away from it. That's the risk we have if we try to go long a stock that's 1, 2, 3, 4, 5, maybe 6 days in a row to the upside, is that we do get that snap back pullback. That's why I want to put positions on as best we can into support levels like 57 per share or into rising moving averages or just bull flag trades in general. So watch these stocks carefully, what that means for the broader market, and of course our S&P 500 into the 2900 and then 2911 gravity spot. Bearishness abounds unless we're above those levels, so watch those closely into the next week. But as always, be careful and safe. This is Corey Rosenblum with your Theo Nightly video for June the 13th, 2019.